Hello and welcome to our latest investment update as of July 2nd, 2020. I'm Mark McCarron, Wescott's Chief Investment Officer. And in this week's edition, we're going to talk through the market and economic outlook. As we typically do, the market update is through July 2nd. We're also going to review the key themes of the second quarter and begin to put together our third quarter outlook. So first, a quick update as to what's going on in the economy and the markets. First of all, the world economy continues to reopen despite the rise in global virus cases, not only here in the US, but elsewhere. Against that concern, which is clearly a concern, manufacturing activity is rebounding, according to the latest polls and surveys. So we look at US, Europe, and Asia. We look at the IHS market surveys, which are manufacturing surveys through June, they're actually showing expansion, obviously from a very low base, but it's an improvement. And the market is reacting positively to that. However, the recent uptick in cases in some parts of the US could absolutely slow this recovery. And so while things look pretty good today, the uncertainty is still with us. So one of the things we want to do today is just look at the second quarter. So this is a market update through June 30th. And as we talked about many times before, we're tracking the S&P 500 as a proxy for the US stock market. And that is the blue line here. And clearly the decline that we saw in the first quarter was dramatic, nearly off 30%, but the recovery has been dramatic as well. The S&P has nearly erased all losses for the year and finished the second quarter and the year-to-date period ended June 30th down about 3%. We've also introduced this idea of an S&P 500 equal weight index, which is the same 500 stocks but equally weighted. It's more broad-based, and actually it does show that there is a recovery, but the market is still down by using this measure by nearly 11%. And really important, the dynamic between growth companies and value companies has been important to monitor and to watch. The gray line shows the return to the growth index, the Russell 1000 Growth Index, which represents large cap technology, healthcare, and some consumer staples. The yellow line shows the benchmark that represents value companies. That would include energy, financials, industrials. And you can clearly see not only this year, but actually the last 5 years, there's been a widening gap between the growth company performance and the value company performance. And this quarter was no different. In fact, this year has been no different. The Russell 1000 Value Index is still off 16% year to date, while the growth index is up nearly 10% year to date. And we talked about this in earlier presentations, but the NASDAQ 100 is up over 30% just in the second quarter alone and finished the year-to-date period through June up 16.8%, clearly an outperformer and driven really by that technology and healthcare allocation that is well represented in that index. And as a reminder, we were able to allocate to the NASDAQ 100 in client portfolios in March during a period of extreme weakness to take advantage of the price opportunity that we saw at the time. And we'll talk a little bit more about that when we talk about and review the actions we've taken throughout the quarter and year-to-date period so far. So getting a little bit further, the market is differentiated between growth and value, and that's the return of the stocks. But it's important to look one level below that and look at the drivers of earnings and earnings estimates. So on the right-hand side, we're showing what analysts are estimating for earnings growth for all sectors in the US market. So, and this comes from CompuStat, which is a data source that does compile earnings estimates, and JP Morgan Asset Management Guide to the Markets is the source of this data. And if you look at what analysts were estimating as of 12/31/2019, so at the end of last year, for 2020, That's represented by the gray bars here. And it looked pretty rosy. If you look at every sector in the market had a positive expected earnings growth number associated with it. And in fact, there was high expectations for significant earnings growth in the industrial, consumer discretionary, and the energy sector. Well, that all changed, of course, with the global pandemic, which is an external shock to the economy. Those expectations of recovery and earnings growth were dramatically changed. And so those estimates from analysts on earnings for 2020 as of June 29th, 2020, so the most recent estimates, show that energy earnings are expected to drop by over 100%. Consumer discretionary, that's really driven by consumers' decision to buy non-essential items, if you will. Travel is included in that. Vacations are included in that. Well, that's expected to drop by 57%. And industrial is down 49%. Those are earnings expectations. That's what people expect to happen in the next 6 months for S&P sectors. So what's interesting to note is that the expectations are very little change for utilities, technology, and staples. That's the section over here. But there have been significant, as we talked about, revisions downward for energy, discretionary, and industrials. And that's what's driving the difference between value stocks and growth stocks. However, everything comes at a price. So these cyclical sectors are very, very cheap when compared to the staples sector or the technology sector, which still remain quite expensive when you look at their earnings and the price you have to pay for those earnings. So what's driving this? We think that the policy response by the US continues to be very important. We've talked about this throughout this year so far. We learned today that US Congress may extend fiscal support to businesses, to employees, and to households in general. But what we're showing here is that the Federal Reserve continues to keep monetary policy very accommodative. That means that the interest rate policy, the policy rate for them is going to be set at zero today. It is zero today. And expectations are that it's not going to move from zero for many years, in fact. And while this supports global capital markets, financial markets, the low rate environment does limit government bond returns to some degree, because lower rates means lower yields, and lower yields ultimately mean lower returns. However, a lower rate environment does support equity valuations to some degree, because as you look forward and discount earnings in the future back to today's values, you're using a very low discount rate, which allows for a higher earnings multiple. And I think that's really what's driving the growth versus value dynamic that we're seeing in the market, and will continue to have an impact going forward. However, at some point, valuation does matter, and it's important to maintain that allocation to stocks that have the upside potential in the future. So one of the things we want to do today is just remind everyone of the actions we've taken in 2020, which included the increased quality in both the equity and the fixed income components. We started that in 2019 and continued that in early 2020. We talked about the opportunistic purchase of some of the market-leading U.S. consumer and technology stocks, which we did via the Invesco QQQ ETF, and that occurred in March, end of March 2020. Importantly, we maintain a core allocation to value-oriented managers because the valuation advantage of value versus growth and cyclical versus defensive remains very attractive. And we want to maintain exposure to that as economic conditions improve and growth recovers. And finally, we wanted to talk about the introduction of a hedged equity strategy in client portfolios that have more of a conservative profile. And that was done on June 30th, just at the end of the quarter. And if there are any questions that you have on that particular addition, we recommend and suggest you reach out to your advisor with any questions you might have. So a quick review of our third quarter 2020 outlook. As we talked about before, governments will try to limit the spread of the virus without imposing severe restrictions on their economies. And that's really important. We do not see another global lockdown, even if confirmed cases continue to rise. As a result, we expect a U-shaped economic recovery. But as we talked about today, it will remain uneven, and the uncertainty around what will drive the economies will ultimately drive market volatility. The S&P 500 index as in aggregate is trading at a relatively expensive 21.7 times earnings. So you have to pay over 21 times earnings for the S&P 500 today, and that is much higher than it has been historically. As we talked about, the cyclical sectors, energy, industrial, financials, they are trading at much lower multiples than the market overall, and much lower than technology and consumer staples. And importantly, that's the infrastructure within the market itself. But if you take one step back, the upcoming U.S. presidential election, we think will be another source of uncertainty, as it typically is, and ultimately could lead to more market volatility in the third quarter as we approach November. So finally, and again, thank you for joining us and your confidence in Wescott. Please do not hesitate to reach out to me or your advisor if you have any questions. We wish you and your family a very good, happy, and healthy 4th of July weekend. And again, thank you for your support.